Hello, and welcome to today's course, which is a brief introduction to accounting. I know, just the word accounting evokes excitement and wonder, and everyone is on the edge of their seats to hear how the debit or the credit misbehaved and how a brave accounting hero. Yeah, we all know accounting is not lion taming and will hardly be full of thrills. But this course is intended to be a glimpse into the basics of accounting for non-accountants. So sit back, relax, grab a slide rule if you've got one, and let's get started. Accounting is basically keeping track of what needs to be tracked in the way it should be tracked. Yeah, I know, it is a word salad, but as we go through this course, you will see that it is quite accurate. Our objectives today are to understand the basic mechanisms of accounting, to explore basic terms of that peculiar dialect called accountant speak. We'll discuss what a typical business accountant will do on a daily or monthly basis and why. And we'll touch on how information systems impact the accounting function. We will take a few stops on our journey today, including the fundamental accounting equation, which underpins all transactions, the double entry accounting concept, what is a ledger and how it's used. We'll talk different types of financial statements, and we'll talk about the month end. The accountant's Groundhog Day, another month always ends up coming around. Our first stop is the basic accounting equation.
Seriously?
I'm out. Yeah, I get it. Equations make the brain start to get foggy, and we feel ourselves absentmindedly pondering whether the milk in our refrigerator is expired or anything, to not do math. But I promise, this is the only equation we will talk about. And it is so fundamental to the understanding of accounting that I risked causing you to suddenly fall asleep mid-video by simply introducing it. And here it is. Assets equal liabilities plus equity. Now let's unpack some of those terms. An asset is something you own. A liability is something you owe. Equity is what is left. Assets might include things with value, like bank accounts, buildings, furniture, or software. And liabilities would include things like loans outstanding for you to pay to the bank, amounts owed to suppliers or vendors, or amounts that needed to be paid to tax authorities like payroll taxes you've collected. Now, the difference between your assets and liabilities is in the realm of personal finance called net worth, but in the area of business it's called equity. And equity can consist of amounts paid into a business like stockholders buying stock or otherwise making capital investments, and also consists of amounts from prior or current year business activity left over, having paid all expenses. That's called net income. For a business, a year's net income that is retained in the company, so not paid out to shareholders as dividends, becomes a part of equity called retained earnings. And we will touch on that again later. So equity equals investments plus retained earnings. Now that takes us to discussion of the first financial statement, the balance sheet. This is a report that lays out a company's net worth, putting assets in one section, liabilities in another, and presenting how much equity the owners have at any given point in time. This is usually done monthly, and is why accountants' lives revolve around the efforts of the monthly close. In the assets section, we list what is owned. In the liabilities section, we list what is owed, and the difference is equity. Now, the moment we've all been waiting for, seeing the accounting equation in action. Okay, let's consider a business transaction. A company is buying an office building. Buying a building is a transaction, so it must be tracked in the way it should be tracked. Now, the price of the building is, say, $10 million. Let's say it was purchased by getting a $10 million loan from a bank, so no down payment, right, just to keep it simple. The first thing your accountant will think about is what happened financially. Two things happened. First, we now own an asset worth $10 million. That will increase the asset side of the equation. To keep it all in balance, something must also increase. You got it. In this case, the liability balance would increase, since we owe the bank $10 million. Then we are balanced. Alternatively, let's consider if the company had bought the building for cash and wrote a check for $10 million to acquire it, what happened financially? Well, we now own an asset worth $10 million, so we increase the asset side. But this time, it doesn't have a liability. So what else changes to keep things in balance? Right, also assets. We've basically traded one asset for another in this case. We've traded cash for a building. So the plus and the minus are both on the asset side. And we are in balance. Now remember, all of these possible entries and treatments are floating through an accountant's fevered brain as soon as you say, buy a building. Now, there is a very specific mechanism for getting transaction details separated into proper accounting buckets. The chart of accounts. When recording transactions, accountants will choose certain accounts in the company's list called the chart of accounts. And each account in the chart has a certain type, an asset, liability, or equity. Sound familiar? But there are also income accounts and expense accounts. Let's take a brief detour about income and expense accounts. These are often called income statement accounts. The income statement is a detail of income and expense activity for a period of time, like a month or quarter or year. And the net earnings here is called net income for that period. And if you remember, net income is part of retained earnings, which itself is part of equity. So balance sheet accounts are of the type asset, liability, or equity, and income statement accounts are of the type income or expense. And the income statement accounts are rolled into equity as retained earnings at any given time. Let's now discuss how the chart of accounts is used in transactions and the concept of double entry accounting. In the spirit of keeping everything in balance, all accounting transactions have two parts, a debit and a credit. And this approach is called double entry. When debits equal credits, an entry is balanced. A debit, sometimes abbreviated as DR, is often represented as a plus, while a credit, sometimes abbreviated as CR, is represented as a minus. This helps to understand how entries balance. Debits plus credits equal 0, meaning the entries are balanced. But the truth is, debit versus credit has nothing to do with mathematical sign. It simply is this. Debits are on the left and credits are on the right of entries. So how does an accountant decide what account gets debits and which account gets credits for any certain transaction? A debit will increase an asset account or an expense account. Conversely, a credit will increase a liability account or an equity account or an income account. Don't worry. As we jump back to our example of buying a building, it will make sense. Remember, we're buying that office building for $10 million, financed by a loan from the bank for $10 million. So to increase the asset account, we will need to put a debit into the building's asset account. And to keep that entry balanced, the credit needs to go to loans payable, a liability account. And this illustrates the mechanism. Assets are opposite from liabilities, so where a debit increases an asset, the corresponding credit will increase the related liability. The accountant would record the journal entry like this. Putting debits on the left and credits on the right, the account to debit is building, and the account to credit is the loan liability account. Note here that credits aren't a minus, right? Similarly, let's say we are buying the building for cash. Again, trading one asset for another. In that case, the entry would look like this. Debit the asset account to increase it by $10 million, and credit the cash account, reducing it by $10 million. Now, hold on a minute. Doesn't a debit card reduce my bank account's balance? And if I get a credit to my bank account on my bank statement, it increases my bank account's balance? Isn't this backwards? Well, it sure feels that way, but this is totally correct. As a wise Jedi once said, many things depend on our own point of view. The statement the bank is sending you is not your asset account. It's their liability account that they owe you.
Whoa.
I know, right? Your bank statement is your bank's liability account detail. Debits will decrease it and credits will increase it, thus the name debit card. When you record your bank's transactions that you find on your statement into your own accounting records, you will reverse that posting in your cash asset account. Debits will increase it and credits will decrease it. Thus, every entry on your bank statement must result in an equal and opposite or mirrored entry in your company's financial records. And that, my friends, is why accountants have jobs. Let's talk about some tools that accountants use. Accountants have an old school method of visualizing how transactions and accounts will behave and will affect the balances in the financial statements. Those are called T accounts. No, not that sort of T. T accounts. In this case, T represents an account, and we put the debits on the left side underneath the T and credits on the right. The balance in any account at any given time is the sum of debits minus credits. Note that T accounts are not part of a company's financial record. These are not entered into any accounting system. Think of T accounts as a scratch paper, where accountants can visualize movement across accounts as they determine the proper way to track what needs to be tracked. So let's return to our example of buying our building and financing it by taking out a loan from the bank. To visualize this, we would have two T accounts, one for the building asset and the other for loan payable liability. The building will get a $10 million debit on the left, and the loans payable would get a corresponding credit on the right. Now let's consider what happens down the road when we make our first loan payment, say in the amount of $5,000. Paying down the loan a bit every month will slowly reduce the credit balance in the liability account with debits, like this. But where does the corresponding credit go for this entry? So step back. What's happening financially? Remember, we are making a loan payment. And that means cash is going out the door. So you got it. The corresponding credit will go to cash, reducing the cash balance, since that's an asset account. Let us dive into another real-life example to illustrate not just a single purchaser of something, but the purchase of something in normal course of business, like, say, a box of staplers. This is particularly relevant because accountants jealously guard their favorite staplers almost as much as their adding machines. Almost. Okay, let's talk about Steve the accountant, who ordered a box of coveted staplers and has a bill from the supplier for the cost in the form of an invoice to be paid later. That box of staples cost, say, $100. Now, Steve must decide how to book this transaction, which is how to record it in the accounting records. Now, these actually used to be books, like physical books, but we'll get to that later. What has happened financially in this case? Well, we have a box of staplers now, but we haven't paid out any cash yet. We just have a bill to pay later. That sounds like a liability, right? Right. I'd like to make a note here about the staplers. Staplers, though of immeasurable value to an accountant, are not big enough to be considered an asset on the balance sheet. It isn't necessary to track them in asset buckets like we would want to track the values of big things like cash accounts or buildings. Enter now the term accounting treatment. A building would be capitalized, that is, recorded as an asset and presented on the balance sheet. But a few staplers, they would be expensed. And that means to record into an expense account, charge entirely against net income for that period. So that expense of $100 will reduce net income by $100 in the period and will thus reduce retained earnings. This is called expensing something. So by the equation, we increase the liability in the amount that we will pay later, and we decrease retained earnings via an expense account. Again, balance. So to record this transaction, Steve would make the following journal entry. Debit of $100 to the office supplies expense account. And the credit? Wait, we haven't paid it yet, so it's a liability. He would post a $100 credit to the liability account called accounts payable. Now, it doesn't live in accounts payable forever. At some point, the $100 must be paid. And Steve must write a check for $100 to the vendor, relieving that $100 accounts payable balance and reducing cash. But how does he remember? Perhaps the ever-helpful sticky note. Steve's beautiful office wall would have a sticky note to pay this vendor at some point in the future. But think of how that scales. For thousands of vendors in a large company, the sticky note approach could become, well, we'll just say inefficient. There must be a better way. Here now, the moment I promised, enter the concept of a ledger. Actually, multiple ledgers. Historically, ledgers were actual bound books containing debits and credits on for ages. In lieu of a sticky note jungle, accountants used a separate ledger just for remembering what is due to suppliers in the accounts payable account. So no more sticky notes. Consider an accountant way back when ledgers were separate volumes. In this case, one for accounts payable and another for expenses. Steve would have to post a credit to the accounts payable ledger to record that we owe a supplier $100. He would also post a $100 debit to the expense ledger to show that we expensed that cost. But where is the record of the entirety of this transaction, the debits and the credits, the balance to zero? That's kept in the general ledger. The general ledger is a book containing every transaction with its debits and credits together, always balanced. This is the central database for all accounting transactions, and other ledgers are called sub-ledgers. In this example, every time Steve posts to any subledger, he must also post the same line to the general ledger, or the GL, in a journal entry, so that everything always matches between different ledgers. The journal number lets the accountant cross-reference all entries across all ledgers. Now, as you can imagine, before computerized accounting, the process of maintaining books as actual bound volumes was painfully slow, and the amount of paperwork likely huge. Thankfully, with the advent of computerized accounting systems, that process was enhanced greatly. But before more recent advances like OCR or document storage archives in databases, there was still a lot of paperwork. And though ledgers were technically digital, all transactions still originated on paper. Our familiar invoice for staplers would have to be stamped and logged and booked and filed and retained for reference and auditing, and accountants have to produce the source documents for every debit and credit in any ledger at any time. The mountain of backup paperwork necessitated that accountants work in file cabinet labyrinths, surrounded by mazes of file cabinets and storage bins. These strange, dystopian landscapes were not for the faint of heart. Many hours and days could be lost searching through dusty files for the elusive journal entry backup that evades even the most seasoned accounting archaeologist. Thankfully, these mountains of paper files are increasingly rare. As companies transition to hosted e-document archives, they employ OCR and capture accounting workflow within accounting systems themselves, rather than paper documents and stamped or signed approvals. Now let's take a look at how different ledgers in a modern context interact with each other in a computerized accounting system. In order to understand some terms, we must first discuss how computerized ledgers interacted with other ledgers. This is important as companies sometimes employ many systems from decades past which still behave in this old school way. Consider again our hero Steve, recording the invoice payable to a supplier and the office supplies expense. In an old school computerized system, Steve would enter the supplier invoice into a section of the software called something like an accounts payable module. He would tell the system that an expense was incurred, where the debit belongs, and the system knows that the credit will always belong to accounts payable. But that's as far as it goes at the time of data entry. The general ledger is not yet affected, so the transaction is in kind of a limbo state. It's posted, but not entirely. Enter the concept of batching. In these types of systems, such accounts payable transactions would be held together in a queue to be completed later, usually on some daily or some hourly schedule. In terms of ledgers, the transaction was posted to the accounts payable subledger, but not yet posted to the general ledger. The GL finally gets the transaction posted when a batch containing this transaction is processed by the system. Think of a batch as a huge stack of records, all waiting to be dumped into the GL as entries. Thankfully, since computers never have bugs, or processing glitches, or power outages, or software conflicts, or ever encounter user errors at all, batching processes are always perfect. Yeah, I'm laying on that sarcasm pretty thick. Even though an accounting process is computerized, it doesn't mean it can't be delicate. Though modern accounting systems have evolved away from batching in many cases, and transactions are often posted live to all related ledgers, the concept of a subledger that needs to be reconciled to the general ledger is alive and well. Who performs the superhuman task of making sure all balances post correctly between all ledgers and subledgers? Enter our superhero, the accountant. Yes, accountants are people of rare and seemingly magical abilities with which few are possessed. They understand at a superhuman level how all ledgers interact with each other. They dream of Excel formulas, literally. They are reconciliation ninjas. Running on coffee, they often have no measurable social life. They love working in dark, remote places. Seriously, they dream of Excel formulas. And they thrive in isolation, like file room fortresses of solitude. Their daunting task is to guide all others through the dark recesses of the dreaded month close. And when they're done with that, well, they do it all over again the next month, over and over, like Prometheus with an adding machine. The close. Those words sting the accountant's ear. Every time a financial statement is issued, every single month, they must make sure everything that needs to be recorded as an accounting transaction is recorded in the way it should be recorded. Sound familiar? Just imagine the volume of sticky notes they will need to make sure it's all checked. Was all revenue recorded properly? Did we reconcile the bank statements and capture all activity there? Did we book the payroll tax amounts? Did we pay the mortgage for the new building? Did we even record the purchase of the new building in the first place? Did Steve mistakenly record that box of staples as an asset instead of an expense? Did all batches work properly? Do all the subledgers match or balance to the general ledger? Let's review every balance sheet individually to make sure it is correctly stated. This is called balance sheet reconciliations, and there could be thousands. Does Steve even have enough coffee to make this happen? The list goes on and is unique for every business. This close process can take from around a week, if quite efficient, to a few weeks, something like average, to several months to button up a close date, if processes are not very particularly efficient. Steve has his work cut out for him. This can mean putting in long hours and mind-numbing reconciliations during month end every month forever. Early mornings and late evenings until the efforts are done are required. This also often means that accountants are entirely focused on closing for significant portions of every single month, and value-add project work often takes a backseat at those times. Making sense of a high volume of transactions during close, reconciling balances, identifying missing entries, and constant cross-checking would require a robust set of tools for accountants to use, right? Right. An accounting hero's tools are many. Excel. Yep, that's it, quite often. Just Excel, no Spanish Inquisition here. When in doubt, when all else fails, an accountant can take almost anything and make sense out of it using a spreadsheet. In fact, you might say,
don't do it.
We excel at it.
No.
Yeah, seriously though. Even now, with data analytics tools at our fingertips, directly from accounting systems, accountants are so used to using Excel that we too often fall back into using Excel as the last resort to push through difficult accounting tasks manually. Honestly, sometimes it is often the only way to handle certain things. And though it can be drudging to jockey a spreadsheet for a complicated problem, it may be the only option at hand. And the month close waits for nobody. We sharpen our Excel skills against ever complicated problems, contorting formulas to perform layers of calculations, links with file sizes that take several minutes just to open, and then we do it all over again the next month. The modern landscape of accounting and accounting information systems poses a new dilemma for companies when hiring accountants. They don't just need an accountant who understands accounting and ledgers and debits and credits. They need accountants who are also information systems savvy and Excel experts, but also know how and when to break from Excel and use new tools. This balance is increasingly hard to find. A person who has jockeyed ledgers and spreadsheets for an entire career may not be familiar enough with the newest bells and whistles of a modern ERP system to know how to come off of Excel. And conversely, one who is quite familiar with how parts of an ERP system work hasn't always been deeply exposed to how those parts play together in terms of ledgers and subledgers and financial statements to truly envision the right solution for the problem at hand. It is important for business leaders to understand this balance of skills and experience and provide tools for learning and process improvement for their trusted teams of accountants. When addressing any accounting information systems process in an organization, this would be a good recipe for success. First, understand what accountants need. What are they trying to accomplish in a process in terms of debits and credits? Think of those T accounts and how debits and credits behave at every turn. Second, envision how transactions will look in the general ledger, on the balance sheet, summarized in the income statement, in subledgers. Will those be right? And third, slow down and understand the full cycle of what needs to happen from an accounting perspective, debits and credits, regardless of the system. Only then will you understand the outcome well enough to architect a system process that will be complete and correct. Thank you for taking this walk with me today, getting a glimpse into the mind and life of an accountant in business. I hope that the material here helps you understand the overall accounting equation, debits and credits and ledgers and books, the month close process, and the increasingly vital part that information systems play in the accounting function. We can now envision how all of these tools help us to track what needs to be tracked in the way it should be tracked. Thank you.